The unseemly spat at the London Stock Exchange has kept the city intrigued for weeks. Hedge fund manager Sir Chris Hohn has tried unsuccessfully to reinstate Xavier Rolet, the stock exchange's chief executive, and to defenestrate its chairman, Brydon, but the real motivation behind the scenes remains opaque. It all makes for riveting gossip in the square mile and Canary Wharf, but it masks a much bigger issue that affects people well beyond those confines. While the London Stock Exchange is being treated like a plaything by a hedge fund manager and trying and failing to merge with its German counterpart, it is no longer properly fulfilling its function of raising capital for growing British businesses. The LSE has seemed more concerned in recent months with trying to flex the rules so it can attract Saudi state oil company Aramco to list here. This is despite there being an inauspicious history of companies where the rules have been bent, the most memorable of which was the debacle involving Kazakh mining company ENRC.A. In October this year, there were just under 940 firms listed on the main market, compared with 1,140 a decade ago and 1,735 in January 2000. AIM, which vaunts itself as the most successful growth market in the world, is a shadow of its former self. The stock market is vital for this. Banks are there to provide cash and liquidity, not long-term investment funds. And, as seasoned commentator Justin Urquhart, steward of 7 Investment Management, points out, there are no local stock exchanges anymore. In 1945, there were 45 up and down the country, and they were the crowdfunders of their day. Now, despite the privatizations of the Thatcher era, small investors own just 12.3%. If the next boss of the London Stock Exchange can bring us closer to being the nation of shareholders Mrs. Thatcher dreamed of, it will stop capitalism becoming a dirty word and could even help keep out Jeremy Corbyn. He or she would be performing a real service.